Everyone knows AI needs chips, but the next phase of the trade may be decided by something less obvious. Who can power the data centers? Who can connect the machines? And who can earn back the spending? That is the real shift. The AI trade is moving from one simple question to a bottleneck map. Chips, power, networking, cash flow. The boom only works if all four gates open. The first AI trade was easy to understand. Who supplies the chips? That question drove the early wave of market leadership. GPUs, accelerators, and the companies closest to model training became the obvious beneficiaries. The logic was clean. If every major company wants to build AI, they need compute. If they need compute, they need chips. And if chip supply is scarce, the suppliers closest to that scarcity get pricing power. That was phase one. But phase one is no longer the whole map. The AI boom is becoming an infrastructure test. Models need chips. Chips need data centers. Data centers need power, cooling, land, networking, and financing. Every one of those layers can become a constraint. That is why the market conversation is shifting. Investors are no longer only asking whether AI demand is real. They are asking whether the build-out can happen fast enough. They are asking whether hyperscalers can earn acceptable returns on the spending. And they are asking whether the next winners may sit outside the obvious chip trade. This is where the second phase starts. Phase two is less obvious because it is not one clean, single company story. It is a chain of constraints. The chip company can be right, but the power plan can be late. The data center demand can be real, but the network can become the bottleneck. The cloud platform can spend aggressively, but the payback still has to show up in revenue, margins, and customer returns. That is why this trade requires a map, not a slogan. Power is now part of the AI thesis. If a data center cannot secure reliable electricity, model demand does not matter. The customer may want more compute. The cloud platform may want more capacity. The market may want more AI revenue. But without power, the facility cannot run. That is why utilities, nuclear power, grid equipment, transformers, and long-term power contracts are moving from boring infrastructure to strategic AI assets. This does not mean every power-related stock is automatically attractive. It means the constraint has moved upstream. The question is no longer only who has the best accelerator. It is who can bring enough power online, at the right cost, in the right locations, with enough reliability to support the workload. No electricity, no compute. Networking is becoming just as important. AI clusters need thousands of processors communicating at extreme speed. The bottleneck is not only compute, it is how fast the machines talk to each other. Optical networking, fiber, switching, and interconnect are moving closer to the center of the story. If the machines cannot move data efficiently, raw compute does not translate into useful performance. That changes the investment lens. The market has to look beyond the headline chip supplier and ask who benefits when data movement becomes scarce. In the first phase, investors asked who has the chips. In the second phase, they ask who controls the system around the chips. Then there is custom silicon. The largest cloud platforms want more control over cost, supply, and performance. Amazon, Google, Microsoft, Meta, and other major platforms all have incentives to lower cost, secure supply, and design chips around their own workloads. That does not automatically destroy the GPU leaders. It does not mean the current leaders lose overnight, but it does change the bargaining table. When customers become large enough to design more of the stack themselves, the economics can shift. They may still purchase premium accelerators. They may still need the broad ecosystem. But they also want leverage. They want optionality. They want a way to keep the AI build-out from becoming completely dependent on one part of the supply chain. That is why custom silicon matters. It is not a simple bull or bear headline. It is a sign that the AI infrastructure trade is maturing. The risk is that investors turn every bottleneck into a bubble. A real theme can still become overowned. A real business can still become overvalued. And a real data center need can still become a capex hangover if utilization, pricing, or AI revenue fails to catch up. This is the cash flow gate. Spending is not the same as payback. Construction is not the same as monetization, and demand excitement is not the same as durable returns on capital. The capital cycle matters. If companies spend aggressively on data centers, chips, power, land, and networking, investors eventually ask a tougher question. What does the business earn on that spending? Are customers using the capacity? Are margins holding? Is pricing strong enough? Is the balance sheet still flexible? And is AI revenue growing fast enough to justify the infrastructure base being built today? That is where discipline matters. The Apex Wealth AI framework is simple. Follow the bottleneck, but verify the economics. First, identify the constraint. Is it chips, power, networking, cooling, land, or financing? Second, ask whether the company actually controls that constraint. Scarcity only matters if it can translate into pricing power. Third, check the balance sheet. Some infrastructure winners require heavy capital. Heavy capital can still work, but the funding source matters. Fourth, look for monetization proof. The best AI stories do not only say demand is huge. They show evidence that customers can earn a return. Be careful with stories that depend only on excitement, debt-funded build-outs, or private market valuation hype. This is not about being anti-AI. It is about being selective inside a real theme. The best setups are not always the loudest stories. Sometimes the strongest economics sit in the quiet constraint that everyone else ignored until capacity got tight. The AI trade is not over. It is getting more selective. The edge is no longer knowing AI is big. Everyone knows that. The edge is knowing where the constraint is, who controls it, and what has already been priced in. For more market frameworks like this, get the free AI Investors Toolkit from Apex Wealth AI. Educational and informational only, not financial advice.